Hi, my name is Shalako Frempo, and we'll be looking at bank reconciliation statement. So, bank reconciliation statement is prepared by an account holder, that is mostly a current account holder, in order to bring the balance of the cash book, that is the bank column of your cash book, into agreement with your bank statement balance. This is prepared by a current account holder because the current account is what we mostly use for our day-to-day transaction as compared to the savings account. So due to some number of reasons, there are always differences arising from the bank statement balance and the cash book balance. So when it comes to reconciliation, the whole story is that we have an account with the bank, and we as accountants or a company, we keep records of transactions affecting that bank account. That is the same way the bank also keep records of transactions affecting the same bank account. So in all things being equal, the balance from the bank statement should be equal to the balance that we have as an accountant or as an organization. The preparation of the bank reconciliation statement becomes necessary when the cash book balance, that is the bank column, does not correspond with the bank statement balance. The statement is prepared to reconcile the difference between these two balances. The statement outlines the deposit, withdrawals, and other activities affecting a bank account for a specific period. Now let's look at some of the reasons why the bank statement balance and the cash book balance may not be the same. We will always be having differences. One is because of unpresented checks. So these are checks issued to customers which are not yet presented for payment. They are checks issued by a creditor but yet to be presented for payment. They are found on the credit side of the cash book but has not been debited to the bank statement. So in simple terms, these are payments made to customers which has failed to reflect in the bank statement. Let's have a scenario here. You have someone that you are giving money to, so you write a check, you give it to the person, you keep records of such a transaction, you keep records of the payment that you have made. But because the person has not submitted the check to the bank may not have an idea that there have been a transaction like that has transpired between the entity and its customers. So that particular transaction will not be captured by the bank, even though it has been captured by the entity. Two, we have uncredited checks. So these are checks which should have been credited to the business account by the bank but has not yet been credited. These are cash or check deposits into our bank account but were not recorded in the bank statement. In short, they refer to the receipt or inflows into our bank account which did not reflect in the bank statement. So anytime someone gives you check and you deposit a check into your account, mostly takes about 3 working days before the money reflects in your account. So assuming you deposit a check in your account and you request for your bank statement immediately after the deposit, then that particular deposit that you've just done will not be reflecting in your account. But because you received a check, you may have recorded that transaction or that receipt or inflow in your cash book. So this may also bring about some differences between the bank statement balance and your cash book balance. Let's look at 3 omissions. These are transactions which are not captured in our records. Transactions we fail to record in our books. Some of these transactions include standing order. So standing order is a written instruction to the bank by the business or an account holder to pay at a regular interval a specific amount on its behalf to third parties. With time, in recording the transaction for the period, the bank will make payment on the account holder's behalf, and the account holder might forget this arrangement and it will amount to failure to record the payment. Think about this as insurance payment, where you tell your bank to be paying your insurance on your behalf. Every month, an amount should be sent to your insurance company. But you get to a time you forget that you have given an instruction to the bank that this payment should be made on your behalf. So you may forget to record this transaction in your cash book. But because the bank is also acting upon the instruction that has been given, they will keep on making those payments on your behalf. And anytime they make this payment, they will record that transaction. 2, dividend received. So dividends are normally paid directly into the bank account of the firm, thereby making it difficult for them to know the exact amount to recognize. So you have invested in an organization, the organization has been profitable, the organization is paying dividend. You may hear that the organization has declared dividend and they are paying, but as to the exact amount, you may not be privy to. But anytime they pay the dividend, they will pay it directly into your bank account. So the bank will receive the money and record it in the bank statement. However, because you don't know the exact amount you'll be receiving as dividend, you may not capture it in your books, and this will cause some differences between the bank statement balance and your cash book balance. Let's look at the SANE checks. These are checks which were received but not honored by the bank. Anytime a check is received, entries are made in the cash book, but due to it being dishonored, there will be no recognition in the bank statement. So you receive a check from a customer and you deposit the check in your bank account. So anytime you receive the check, you are going to recognize the transaction in your books. But when you presented it, the bank dishonored the check, probably as a result of the person not having enough funds in his or her account. So that transaction has been dishonored. However, because it was dishonored, the bank will not capture that transaction in the bank statement. But because you recognize the transaction when you receive the check, you may have it, and this may also cause some difference between the two balances, and there will be a need for you to reverse the first entry or the entry that was made into your cash book. We have the bank charges and interest, and this is one of the things that is very difficult to determine how much your bank is going to charge you on monthly basis. Sometimes the charges is based on the number of transactions and even the amount involved, and as an accountant you may be thinking of other things rather than how much the bank will be charging us. So until we obtain our bank statements, we may not be able to get the exact amount, but because that is the service fee of the bank, they will deduct the money and they will record that transaction in the bank statement. We have errors. So this is where figures are either overstated or understated. So there is an amount of 110, then when you were capturing it in your cash book, you did 101. This is an error and it's a genuine error. We have wrong debit or wrong credit. This is where the bank credit or the bank debit your account wrongly. Now let's look at bank statements. I know someone will be asking, what is a bank statement? So bank statement is basically a statement that is being prepared by the bank and is sent to the customers, that is the account holder, indicating the account deposit, that is all the money that has been received, and also all the money that has been withdrawn or sent out as payment within a certain period. Amounts deposited to the bank are credited, whilst withdrawals are debited to the bank statement to use the balances at the end of the period. Now, when there is a difference between the bank statement balance and the cash book balance, there is something that needs to be done. Sometimes the error is coming as a result of we not capturing some of the transactions in our cash book. We made an example of the standing order and also the bank charges, where we don't have precise measurement of coming up with the bank charges, and also we forgetting that we have given the bank a written instruction to be making some payments on our behalf. What it means is that the cash book that we have prepared is incorrect, is incomplete, and there is a need for us to prepare an adjusted one or a corrected cash book or an updated one. So we don't re-prepare the entire cash book from scratch. We pick the cash book that has been prepared already, then we update it. So we start with the balance from the wrong cash book, then we just update it. So we start with the balance, then we have on the credit side the payment. So if we have paid bank charges, there is a dishonored check that is reversing or cancelling the initial recognition, the receipt that we recorded. Then we have the standing order, we have overstatement of receipt, then we have understatement of payment, then misposting of payment. Mind you, the credit side has to do with payment or outflows. whilst we have this as receipt or inflows, so anytime money comes into our account, we record it on the debit side, and anytime money leaves our account, we record it on the credit side. So we have direct credit and direct debit, we have misposting of deposit or payment, we have understatement of receipt. So we received 110, then we recorded 101. We have understated what we received, so the difference, which is 9, is still going to be what recorded on the debit side. Then we have overstatement of payment, so we have to record 500 cedis as payment on the credit side, but we ended up recording 5,000. So there'll be a need for us to reduce this 5,000 that has been recorded by 4,500. And in accounting, we cannot cancel like this, so we have to bring the transaction on the opposite side just to cancel the entry that has been made. So that is the overstatement of what payment, that is 4,500, just to reduce this 5,000 to 500. Now, after all the transactions has been captured, we now go ahead to determine our balance. We have to close the account and determine our closing balance. So we add all the debit side, we add all the credit side, then we recognize the total, the side that has the highest total, then the difference is posted accordingly. So after correcting the cash book, that is where we prepare our reconciliation statement. So reconciliation statement, we start with our balance from the adjusted cash book, what we just prepared. Then we add on presented checks. The whole idea is that this balance is coming from the adjusted cash book. However, there is a check or there is a payment that has been made in our books, but the check has not been submitted to the bank. So the bank may not have an idea of that transaction. So if we want to reduce or we want to reconcile our cash balance to our bank statement balance, then that payment that has been recognized in the cash book but has not been submitted to the bank has to be added. It is being added because in our cash book, this was an outflow. So this was negative, something that was reduced in our cash book to arrive or ascertain our balance. So if we want to reverse its effect, then we have to add it. Then we move to the uncredited checks. Now uncredited checks are inflow, they came to us, there was an addition to our balance. Now because it has not been captured in our bank statement, if we want to reconcile our cash book balance with our bank statement balance, then we have to deduct. Mind you, in our adjusted cash book or in our cash book, uncredited checks came in as inflow. So if you want to reverse the transaction, then we have to do it as an outflow. That is why we are deducting. At the end of the day, if we add our unpresented checks and we deduct our uncredited checks, we should arrive at our bank statement balance. So let's pick a question and let's solve and let's get to see how the whole thing works.